Hello, I'd like to welcome everyone to this webinar on finance, climate risk, and how to make your pension climate friendly. This is the first in a series of 2 webinars. The second will be held in a week on December the 1st. My name is Roy Culpepper. I chair the Group of 78. This webinar is co-hosted by the Group of 78 and Climate Legacy in partnership with Shift and the Unitarian Church. In a moment, I'll introduce you to our moderator, Ricky Stewart, who will tell you more about Climate Legacy and introduce our guest speaker from Shift, Adam Scott. But first, I'd like to acknowledge that the city of Ottawa, the place from which I'm making these introductory remarks, is in the traditional unceded territory of the Algonquin Anishinaabe people. First Nations have lived on and cared for territories across Canada since time immemorial. As we discuss how to combat the climate crisis, we must recognize that Indigenous communities have for many generations stewarded and protected rivers, coasts, forests, and the land. We must learn from their example and respect this legacy. Now, on to our discussion. We all know that money is what makes the economy go round. But whether it does so by financing fossil fuel and carbon-intensive products and activities, or by supporting renewable energy and green technology, that has a profound impact on the climate. While such a statement may now sound like a no-brainer, it's taken a few key people like Mark Carney, former governor of the Bank of Canada and former governor of the Bank of England, to go further and urge the financial sector to reduce climate risks. Not only are current financial choices increasing the risk of a climate catastrophe, but also the deteriorating climate poses an increasing risk to financial assets. Trillions of dollars of assets will be wiped out if the climate crisis is not arrested. In this and the next webinar, we shall explore the interrelationships between finance and climate risk and go beyond to explore what we as individuals can do as members of pension plans, as citizens, to make a difference. Now, it's my great pleasure to introduce our moderator for today's webinar, who will say a few words about climate legacy and introduce our distinguished speaker. Ricky Stewart currently lives in Ottawa, but she's in transit to Victoria, BC. She works part-time as a consultant on organizational change and gender equality with UN organizations, governments, and NGOs. Her daughters roll their eyes when she says she plans to retire. She's lived across Canada, from Nova Scotia to Saskatchewan, and also in Asia and Africa. Ricky was executive director of Oxfam Canada and was deputy director of the Canadian Council for International Cooperation. She has taught at St. Francis Xavier University's Coady Institute. She has been a volunteer teacher, consultant, and board member, and is currently affiliated with Gender at Work and with the Climate Legacy Project. Ricky, thank you for moderating, and over to you.
Thank you, Roy. Just a word about climate legacy. About 2 years ago, a small group of old friends and colleagues in Ottawa came to the conclusion that we weren't doing enough ourselves to contribute to action against climate change. And we began to talk about what we could do to become more active ourselves and to encourage other seniors to do the same thing. And as a result, we set up the Climate Legacy Project. We didn't really want to build an organization, but we contacted a large number of organizations, both big and small, across Ontario mainly, but also in other parts of Canada and in other parts of the world, to ask them what would be the best way to encourage seniors to get more involved in climate action. And this webinar is one of the results, because one of the things that many individuals and organizations we talked to said that investment concerns were one of the ways that seniors who are in the position of if they're fortunate enough of having savings and pensions, could look at to see how they could improve their situation. Climate Legacy will be starting up a website. We'll be working with the groups that we've already contacted to see how we can engage ourselves and each other in taking more effective action using our time, our voice, and our money. And we would encourage you to find us on the web and to sign up for the next webinar. Now, with that, just a word about the process. We're going to hear from our presenter, whom I'll introduce in just a moment, who will make a presentation about the overall dimensions of investment and climate change. He thinks right now that the presentation will take about 25 minutes, which will leave about half an hour for questions and answers. We're going to use the Q&A button at the bottom of your screen so that you can write down any questions that you want. And when Adam has completed his presentation, I will moderate the responses to the questions. I understand, although I've never used this technology myself, that you can, once you see what the questions are, give them higher priority or less priority, and that we can take them off once they've been answered. So we will go into that more fulsomely once we've heard the presentation. One of the people that we contacted when we started to look at what kind of a difference seniors could make, or one of the groups, was Shift Action for Pension Wealth and Climate Health. And its director, Adam Scott, has been with us over a number of times during the past year and a half, trying to figure out how we could reach a broader audience and help people understand what their potential actions could be. Adam is the director of Shift Action. He's worked on climate change for his entire career with an emphasis on investments and finances and their implications for climate change. He's worked in Canada as well as abroad, and he has been a most thoughtful and articulate spokesperson on this issue. So it gives me great pleasure to introduce him and ask him to lead us through his presentation. Adam?
Well, thank you for that kind introduction, and thanks very much for inviting me to speak today. I think this is a really timely and important topic, and there's a lot that's moving quickly on this subject. So it's a good time to have a conversation about it. I think this is something that we're going to see and hear about more increasingly in the future, is the role of finance and investment decisions in addressing the climate crisis. And I think every one of us has some stake in how that comes together. So I shared my screen. I hope everybody can see it okay. I've got a slide deck here, and I'm going to go through those slides as quickly as I can. I will talk quickly. So feel free, if anything isn't entirely clear, to make a note of it and put it in the Q&A. I'm happy to sort of stop and address any of those quick questions that come up, and then we'll have a more fulsome discussion at the end. So yeah, this is a two-part presentation we're gonna go through quickly, and the first today is really focused on the why of shifting finance away from the causes of climate change and into the climate solutions. So sort of the why of why we need to move out of fossil fuels and into clean energy. So that's sort of the bulk of what we'll talk about today. And then next week, the webinar will focus a lot on the how. So we'll get more into detail about how you can personally engage with your own pension fund or through your own investments, if you have some. There's also other ways to motivate community to act on this. So there's lots of activity for actually acting on this. But today we're really going to focus on sort of the nitty-gritty of the why. So we're going to explore really why it's not a trade-off between economic growth and the environment today. So we'll talk about the climate implications of making this shift, but also the fact that this is a very wise financial move to make if we're going to be acting responsibly and investing for our future. So quickly, if folks are available to, I was going to try to put a survey up, but I think it's easier to do it this way. It would be really useful for next week if folks felt like they could put in the chat quickly if they're aware of which pension fund they might be part of, just to note it quickly in the chat if you feel comfortable posting it. And that could be really useful information for us next week. We can dive deeper into some of those funds that come up. And it's worth noting now that all Canadians who are working are part of at least one pension fund. So you're part of the Canada Pension Plan or the Quebec Pension Plan. So we will address that as well. But I'll just pause quickly. Just feel free to drop that in there, and we'll use that information for next week because that'll be really useful.
Adam, just to let people know, the chat function is not enabled.
Okay. So we can do it in the Q&A. Yeah, that might mess things up a little bit. So that's fine. We'll carry on. If folks were asking questions, if you want to note there in your question, you can also just point it out there. But it's useful for us to know who we're speaking to and what sort of information we can bring to next week's webinar. And I'll just move on from there. This is a quick overview of what we'll go through quickly in my presentation. So we did the introductions. We're going to do a brief recap on understanding the science behind climate change, very short and brief, but it's important context, and the solutions and what that trajectory actually looks like. We're going to talk a lot about the various types of financial risk associated with climate change, so the ways in which climate change and the responses to climate change will impact investments of all types. We're going to touch on the opportunities of investing in climate solutions, both the financial and the environmental opportunities. We're going to focus some time on the poor financial performance of fossil fuels, and we'll talk a bit more about the path forward. So we'll try to move through this all quite quickly. So without further ado, a quick recap on the context of where we are today. So this chart shows very clearly the concentration of CO2 in the Earth's atmosphere. We can see that concentration has increased by more than 60% over a very short period of time. And this is measured CO2 concentration in the atmosphere in summer and winter. So you can sort of see it goes up and down. And this is really where that CO2 has largely come from, that has increased the concentration in the atmosphere. It shows the growth in the combustion of coal, oil, and gas, carbon that was previously trapped in the ground but has been dumped into our atmosphere and has significantly upset the carbon balance on our planet. So you can see really this coincides directly with the Industrial Revolution and sort of the Western industrialization that's happened, and then more recently development that's happened around the world. So we've seen this very, very significant and sudden dumping of carbon into the atmosphere. And here are the implications of that. Carbon dioxide and other related greenhouse gases help trap more heat in the Earth's atmosphere. And so over time, if you increase their percentages, there's a direct correlation with warming, the average warming in our atmosphere. And this is what that looks like. This is what they call the temperature anomaly. And over that same period, we've seen an increase in greenhouse gases. We've seen a corresponding increase in global average surface temperature. So this is really the scientific consensus that this is happening and humans are causing it. And we've been really clear on this for more than 20 years, in fact. But we're just now coming to grips with what's required to properly address the crisis. The climate crisis is already having very real and substantial impacts on the world we live today. So this is not a conversation entirely about the future. It's actually about impacts we're already facing and how those impacts are going to accelerate over time. So we've seen very substantial, noticeable enhancements to impacts we see every year. So we've seen an increased likelihood of severity of wildfires, floods, heat waves, droughts, sea level rise, extreme weather, all of which damage the infrastructure in our society and and the ecosystems, and have very real economic effects today. And here, this slide just shows some recent examples from our experience. The top left there is Hurricane Harvey hitting Houston, unprecedented flooding a few years back. Top right there is Cape Town, South Africa, the first sort of global city to face a complete lack of water, a major water shortage from a multi-year drought. I was there during some of that drought, and it had a devastating impact on the functioning of the city. We expect to see a lot more of that. The bottom left is the Columbia Glacier in Alberta, which is actually, this is a bit of a sleeper issue when it comes to climate in Canada, but that is the source of the Saskatchewan River Basin, which feeds agricultural water all the way through the driest parts of the Canadian prairies. And it's melting and is expected to disappear by the end of the century. And the bottom right there is the Fort McMurray wildfires. But, I think even since that's occurred, those fires have been dwarfed by even bigger ones in places like Australia and California and all over the world. We've been seeing very severe wildfire impacts. So these are sort of just to remind folks that we're in the climate crisis today. The impacts are already real and measurable and are expected to get worse. And here's sort of what that looks like from a financial perspective in Canada. These are catastrophic losses in Canada since the 80s until a few years ago. And you can see these are insured private losses. And there's a very clear upward trend associated with the same trend from climate change that we've seen. So what do we do to address this crisis? I'm sure most folks on the call will be aware that there's been an international effort to create an agreement between countries about the approach and what's required. And after decades of effort, the Paris Agreement was signed in 2015, which is an international bottom-up voluntary agreement that commits countries to an actual goal. And this slide really shows us clearly what those goals are. We're trying to hold the increase in global average temperature to well below 2 degrees, and aiming to hold those temperatures below 1.5 degrees. And that's quite significant. The Intergovernmental Panel on Climate Change, which is sort of a UN body that actually compiles the latest cutting edge science on this matter from around the world, had started warning that 2 degrees was too high of a threshold. It's too dangerous to try to hold warming to that level. We would see catastrophic impacts and irreversible impacts at that threshold. So 1.5 was a much safer line to hold temperatures to, and that was reflected in the Paris Agreement. So that's a very clear red line that we're actually gunning for. Canada has signed this agreement. We've also ratified it, so it's legally something we're obliged to follow through on. But key to the Paris Agreement, and often not talked about, is there's actually a paragraph that references finance, and this says making finance flows consistent with a pathway towards low greenhouse gas emissions. It is absolutely critical that, in addition to just government decisions, that finance decisions, private investment decisions, lending decisions all over the world must align with a Paris trajectory. And I'm about to sort of show you what that should look like. So there really is a path out of the worst impacts of the climate crisis. We have no choice but to essentially cut off the root source of the problem, ending fossil fuel combustion everywhere, and addressing industrial emissions and land use change as well. But first and foremost, this is a transition of our global energy systems. And so this graph really shows what addressing the climate crisis requires to stay below a 1.5 degree limit. And there are really two things I want you to quickly take from this chart. The first is that we're not aiming to reduce emissions. That's not the goal of addressing climate change. We're trying to eliminate them. There's a very big difference between those two concepts. We can't just pursue efforts that marginally reduce emissions. We're actually in a race to actually bring emissions globally down to zero by mid-century if we're going to stay on this trajectory. And you can see The black line on the left there shows actual emissions as measured over recent years. And the pathways that come down there are the trajectory for the drop in global emissions that we need to see. So had we started back in 2000 when we still had all of this information we needed, and we've been having this discussion for a long time, we would have had a very smooth, gentle curve. We would have had a lot more time to act. And every year we've delayed action, we can see that curve has gotten steeper. And that's the second thing I want you to take away from this, which is there is a cost to inaction. It becomes harder. And every year that we don't act, and it becomes nearly impossible at a certain point. That curve gets too steep to navigate. And we've already waited arguably too long to stay below this threshold, but every attempt we make will dramatically improve the future. So this is all sort of really core context to understand that we're aiming to cut emissions. Canada should expect to cut its emissions roughly in half within 15 years and to zero in 30. That's what the Paris Agreement goals mean. And that's a very, very heavy lift. It's unprecedented in sort of our societal history. And it's much more ambitious than most of the conversations that we're currently having about climate change. So yeah, as I mentioned before, that kind of transition doesn't require just some government policies. It requires a substantial shift in global capital, because a huge amount of decisions made every day behind closed doors are about where to put an investment or where to make a loan. And we can't be financing more of the cause of the problem that's driving emissions up. We have to be immediately moving that capital into places where we're actually actively driving emissions down quickly into the solutions. And this graph shows quickly, it's a bit of a complicated one, but I'll try to say it quickly, what that really looks like specifically for fossil fuels. So this is an important analysis showing how fossil fuels fit within the remaining global carbon budget. And a carbon budget is just like any other sort of budget. There's actually a cumulative amount of carbon we can dump in the atmosphere over the rest of the century. And that scientists can correlate that with the temperatures that we're trying to hit. So essentially, for every temperature threshold, if we're trying to hit 2, there's a certain amount of carbon you can dump in the atmosphere to have a reasonable chance of staying below it. And likewise for 1.5. So what you're seeing there, the 2 and the 1.5 represent sort of the outer bounds of the Paris Agreement goals. And that big bar on the left is what we're paying attention to here. It shows how much carbon is already held within existing and already developed coal, oil, and gas fields and mines around the world. So we're not talking about, future untapped reserves. We're talking about coal, oil, and gas reserves that have already been developed and exploited, have already been explored for, and are ready to go or already producing. If we were allowing the existing fossil fuel infrastructure globally to play out and exploit everything that's already tapped, we would far exceed the 2-degree threshold. So what that means is we have to quit exploring for fossil fuels. We have to stop developing new fossil fuel fields and mines. And already a lot of what has already been put into development will not get to run out its natural course. So there's substantial financial risk inherent in that. And I hope that's clear. That's a lot of information on one slide. So today's conversation on finance will be directly guided by this knowledge. While fossil fuels are undoubtedly part of the world today and they won't go away overnight, we must recognize that we can't keep digging for them. That must also mean that we can't keep financing, lending, and investing into new and expanded fossil fuel projects. And it means that a considerable amount of existing projects will become stranded. So fossil fuels are very risky because of climate change and the action we need to take, both for the climate, but also for our finances. So now I'm going to spend a little bit of time quickly running through the different types of climate-related financial risk. And it's important to understand that there's a bunch of different ways in which climate change can impact a specific investment or a company or a loan. And the past, in the past, fossil fuels have been quite a profitable sector, but they face these risks, very substantial risks now, and the world has really changed. So let's go through these quickly. So the first big category of climate risk is the physical risk associated with the physical impacts of climate change. And some of this will be fairly clear and obvious, I think, to most folks. Infrastructure being damaged by wildfires or floods or sea level rise or extreme weather. There are very real and direct financial costs to that. So if we're talking about, say, a pension funds owned huge amounts of real estate, commercial real estate. Will any of that real estate lose value or be damaged by the impacts of climate change? And that's where we're sort of assessing physical risk. So there's a substantial amount of this kind of risk out there in the world. There are a lot of efforts to try to assess where that risk is. And I think the more we look, the more we'll see it. Now, there is, in fact, a huge amount of risk to all sorts of physical infrastructure in our world. The second category of climate-related financial risk can be sort of broadly considered transition risk. I described to you what is required to address this crisis is a rapid energy transition away from fossil fuels to clean energy sources of all types. And those sorts of transitions are very disruptive to legacy industries that are in place. So this is some examples. Here are some examples of some other transitions that happen in different sectors, largely due to technology change, and that's something we're facing right now as well. Oops. You can see Blockbuster Video's video rental model was rapidly disrupted by Netflix and lost all of its value and declared bankruptcy. Similarly, the whole economy back in 1900, when it shifted to cars, never anticipated the speed or completeness of that transition. So it was roughly 11 years between no one driving a car and almost everyone in North American cities driving a car. Very rapid transition that had huge implications. And the top right there is another obvious one, Kodak, the world's largest film company. While it did try to make the transition to digital cameras, it actually owned patents there. They were rapidly disrupted by other incumbent players and also by smartphone makers eventually. So Kodak is not a dominant player in photography anymore. And if you own shares in that company ahead of the transition, you might not have seen it coming. And once it's over, it's absolute. And when it comes to climate change, we're seeing very substantial transition risks in all types of energy. So this is an example of rapid transition in place. The cost of solar power has been plummeting rapidly over recent years. And we're now in a position where we can see that solar power has become, alongside wind power, they're competing heavily for the cheapest installed and operating forms of electricity on the planet. They are now cheaper than coal or gas to generate electricity, and nuclear in most markets around the world. And that's having huge implications for our ability to address climate change, thankfully. That's really good, but it's also having a huge disruption for legacy industries. Likewise, the drop in battery costs is also proceeding at the same sort of exponential pace. And we're seeing a situation where electric vehicles are on track to become cheaper than internal combustion engines within the next couple of years. And that will have obviously accelerate the trends we've been seeing in other areas. You can see, I'll skip over that one. And already we're seeing a flattening of demand for fossil fuels in different categories, and we've seen fossil fuel companies underperform the market in recent years. And I'll talk more about that over the last 10 years, but fossil fuels have already been underperforming and had lower returns than other sectors over the last 10 years. I'm specifically talking about Exxon, which was once the world's largest publicly owned company. The value has really collapsed in the last while. And quickly, I mentioned COVID. COVID pandemic really actually shows us what we can expect in the long term for fossil fuels in general. COVID, we saw a rapid decrease in oil demand, energy demand generally, but oil demand globally all of a sudden as people stopped flying and traveling and driving. And that's had a very negative impact immediately on all the fossil fuel companies. But that's exactly the same thing we expect to see over the next decade or so, is demand for fossil fuels dropping as we were able to make these transitions and switch away from fossil fuels. So the negative financial impacts on these companies is already apparent because of COVID. That's a very sort of helpful view of what it will look like in the future. You can see this is Shell. They took a massive $22 billion write-down, admitting that a lot of the projects that they have operating will never fully get the value that they had anticipated. A third category of financial risk related to climate change is another obvious one, sort of policy and regulatory risks. So, changing laws, policies, regulations that cut carbon pollution. So this could include phasing out fossil fuel production, carbon pricing, internal combustion engine bans. We've seen quite a few jurisdictions set timelines for phasing out all internal combustion engines and switching to electric vehicles. I believe Quebec is just the most recent one to announce this, but we're seeing in California. I think China's exploring a policy. So it's happening, and it's happening quickly. Retrofitting buildings, electrifying the economy. So you can sort of see there's, in order to address the climate crisis, we do expect more and more aggressive climate policy in all of these categories, which will undercut fossil fuels. And there's a legal and reputational risk as well associated with some of this. Just to say that fossil fuel companies have been actively opposing climate action through their lobby groups and their public communications for decades. And there are a number of lawsuits which directly seek damages from those companies. So it's very much like the tobacco industry in the 1990s, denying the link between smoking and cancer. There's a lot of legal risk there that's not been fully mapped out. And finally, I always sort of like to point at the probably the most important but least understood category of climate risk for the financial system. And that is what we refer to as sort of portfolio or systemic risk, which is climate change isn't just an impact on individual companies or investments or individual parts of the economy. When you start having runaway climate change, if we're unable to address the crisis in the way that we're talking about today, we're going to start seeing cascading failures and impacts in different parts of our economic systems. We can quickly get overwhelmed by all of the negative impacts that are coming. So what I'm telling you is that if we don't address the climate crisis directly at its root cause, we're going to face far more cost down the road, and there's no way to shelter yourselves from these kinds of risks. We're seeing global GDP will be negatively impacted by cascading failures. And I've given the example here of the bushfires in Australia last winter, in their winter, or their summer, our winter, last winter, were so dramatic that they shut down large chunks of the country, and they had widespread health impacts and damaged tourism. And, there's been a huge headwind for the GDP of Australia. And we're seeing those sorts of wildfires all over the planet right now. So you have to think about interconnected food systems, water systems, migratory patterns. There are a lot of interconnected global systems that we have, and climate change can disrupt them. So you actually have to think about your overall portfolio. There's no stock picking or careful investment that will protect you from this. So we really do need systemic policy. And Mark Carney, when he was at the Bank of England, was repeatedly warning about these systemic risks to the global financial system. In fact, there's the possibility that if fossil fuel assets are sharply and suddenly revalued, which means valued far less because of the climate crisis, that could actually undercut the stability of the financial system, much like we saw in 2008. So there have been steps taken to stress test parts of the economy against some of the risks I've talked about today. And the Bank of Canada has announced they're going to explore a pilot project doing that. I think they just announced it last week. So we can expect to see stress tests of the financial system related to what I'm talking about. So that was all pretty doom and gloom, pretty scary sort of overview of all the risks. I'm going to try to be a little quicker in the end here. I'm almost there. But I wanted to talk about that financially speaking, all of what I've talked about has an upside. Addressing the climate crisis requires the shift in capital to clean energy sources, and all of those technologies that are doing the disrupting of fossil fuels all have exponential growth curves into the future. A huge amount of efficiency, a huge amount of clean energy, clean transportation, sustainable agriculture, just tons of areas that are set to explode or already exploding. And that's where we're asking capital to flow to. So we're saying, get your capital out of fossil fuels now, move them into climate solutions where we can actually start to bend this curve. And in doing so, you're exposing your investments to huge opportunity and growth in the future. In the next coming decades, this is actually where economies will see growth, where jobs will come from, and where investors will find returns. So it's a very positive story that there's not an opportunity lost. Capital moved to climate solutions will be higher growth and lower risk compared to traditional fossil fuels. And here's some examples of this trend already in place. You can see in the US, we've seen a very sharp drop in the use of coal as coal plants have been shut down. It's not directly, it's not all renewables that's disrupting that. There's other gas technologies coming on as well. But renewables have dropped so dramatically in cost that they're now outcompeting both coal and gas. So even though gas has temporarily taken over from coal and is doing so around the world, very quickly, renewable energy is what competes with gas, and it will undercut gas as well. So moving your investments into gas as a bridge fuel is a very bad idea because renewables already have the competitive edge. And we're seeing what this looks like for utilities around the world who have made the shift and those that haven't. So the 5 cleanest global utilities who do electricity are profiting greatly because they've transitioned a lot of their investments into renewable energy and efficiency, and those that haven't are not growing. So you can see there's a dramatic difference between the performance of companies that or investors that get this versus those that don't. And this is I talked earlier about the long-term financial underperformance of fossil fuels in the market, and this is a really sort of quick overview of what that looks like. This is the S&P 500, which is a big index of publicly held companies in the United States. And they have different sectors. And the worst performing sector over the last 10 years was energy, but not actually energy. That's oil and gas, specifically, and coal. And you can see returns have basically been flat to zero over a 10-year period because a lot of companies are competing for very little growth in demand. And that's accelerating. And I could talk endlessly about this, but I'll spare some time for Q&A instead. There's a lot to talk about in terms of the underperformance of fossil fuels, but let's just suffice to say that it's real and it's measurable and it's accelerating. And I'll sort of point towards the end here. The financial industry is now, because of everything I've just said, coming around to getting on board with what we're talking about, shifting capital. So BlackRock, the world's largest asset manager, announced last year that they were going to rethink their entire investment strategy and base it on understanding climate. This is a letter from BlackRock CEO Larry Fink, and it had a major influence with financial institutions around the world that this is not something that you can just ignore. Smart financial institutions have to get ahead of it because this is the issue that they're hearing about the most. And that's what we're going to talk about more next week, that BlackRock didn't write this letter voluntarily. It was their customers who they manage money on behalf of other people. And those people had been contacting them over and over and over again, demanding that they start taking climate risk seriously. And it worked. This is an institution that is shifting. So I think I'll try to wrap up now and just explain that from a personal perspective, we're all members of pension funds, largely. Some people, if you're fortunate enough to have your own savings invested somewhere for your retirement as well, those investments, no matter what type they fall under, actually have a carbon footprint alongside your own personal carbon footprint. And this is often forgotten. It really matters where your money is invested. And this graphic sort of helps illustrate that a large portfolio actually has substantially more impact when it comes to carbon than a lot of the activities that many of us are trying to take a look at, like changing the way we eat or the car we drive or those sorts of things. So it's really important to actually think about and engage with money that's invested on your behalf, and you can have a huge influence over it. And that's what Shift is really here about to do. We're a project that helps Canadians engage their pension funds and think about how they can shift their investments constructively. And that's what we'll talk about next week. We've got a lot of tools we can go through and go into more detail on where individual pension funds and investments are actually addressing this issue. So on that note, we can move into Q&A, where there's probably lots of things that I'm hoping people want to pick up on from what I just talked about.
All right. So Adam, can you see the Q&A? The first question is, in your carbon budget, when the graphs that showed the carbon budget, there was something called the land use component in the one on the left. Could you explain what that is, please?
Yeah, so land use covers a lot of different areas. It covers deforestation, or it can cover deforestation. And it can also cover the way that we are using intensive agriculture. And depending on how land has been altered, it can impact the ability of ecosystems to absorb or to release carbon. So humans have dramatically changed the landscape around the world, and a substantial net release of carbon into the atmosphere comes from land use change. So it's actually a big and important piece of the puzzle when it comes to solving climate change. We need to be addressing protecting ecosystems and deforestation, and to make agriculture more sustainable and lower carbon.
But it actually was a very small portion of that left-hand bar, much smaller, for example, than cement, which surprised me.
Yeah, that's right. I mean, those estimates vary somewhat, but yeah, it's thought of as a big deal. You know, in Canada, we're having a lot of conversations about, we're going to plant a lot of trees, which can have some impact on absorbing carbon, but the overwhelming cause of the change in the very makeup of our atmosphere is because we've been burning fossil fuels. We've been taking carbon that wasn't part of the global carbon system, and it was safely trapped underground in geologic systems, and it's been dumped into the atmosphere. So it's very hard to rebalance that without actually addressing the root cause, which is fossil fuels. So planting a lot of trees won't do a lot of good unless we actually stop burning fossil fuels as well.
Okay, thank you. Some of the questions have jumped around. So the top one now is, let me go from the bottom then. This is a question from Iola Price. She says, President Trump recently moved to make it illegal for a major U.S. bank to finance oil and gas, specifically in regard to the Arctic National Wildlife Refuge in Alaska. Can you comment on this?
Yeah, I'm not sure if Trump made it illegal, but he's actually doing the opposite. He's been trying to open up the Arctic National Wildlife Refuge. It was closed for oil and gas exploration and development. It had been a contentious topic for decades, and the Obama administration closed the door there. So Trump has been trying to reopen it, and he's also been trying to undermine the market. Right now is actually highly sensitive to those kinds of investments. It's considered a risky investment because, as we can see, Biden is very likely, as incoming president, to say no to that again. So anybody who's spending money on that's going to lose money. Anyway, Trump's been trying to open every possible door he can for fossil fuel development in the United States in the dying days of his term, and I think it hasn't amounted to very much. There's been a decline in fossil fuels, in coal, gas, and oil in the U.S. during his term.
Thank you. Michael Cook asks, can you explain the penultimate slide in more detail? I think that was the one with the graphs about the carbon footprint of your investments.
Yes. Yeah. So this graph, I didn't create it. It's created by there's an organization that's now owned by Van City Bank. They sell green bonds. So they actually offer an investment product related to low carbon investing. And this was pulled from data that they pulled together. But essentially what they're saying is, if in an average portfolio, and in Canada, that would be something that's broadly invested across the economy. If you have an ETF or a mutual fund, you're sort of invested in little pieces of everything. The investments that you hold actually are companies with very real carbon footprints of their own. So it is possible to calculate the carbon emissions per dollar invested as an actual metric. That's one way of measuring climate impact of companies or investments themselves. So what that means is that the average Canadian is invested in if you have an investment portfolio of that size, you've got a very substantial amount of carbon in your portfolio. The largest source of emissions in Canada is not transportation, which is what people often think of. First, it's actually oil and gas production. So oil and gas production is the largest source of emissions, followed by transportation and other sectors. And so if you own companies that are directly involved in oil and gas, digging it out of the ground and producing it and refining it, then you have very substantial carbon impacts in your dollar invested.
Adam, can you show that slide again, please?
Yeah, sure. Is it not showing up?
No.
I'm not sure if I'm sharing right now. Would you like me to reshare?
Just to refresh people's memory. There it is. Thank you.
We like to frame it as it's important to do all of the things that you can as an individual. But this is one that's often overlooked. And it's really important when it comes to climate change to not stress yourself. Your personal actions have an impact, but systemic change is needed. The systems that underpin our society have very substantial influence. And so it's important to think about policy, and it's important to think about finance for that reason.
A question from Ellen Edelberg. Do you do presentations to investment firms?
I have, yep. I've done some presentations for financial advisors and other professionals, but so yeah, I have and I can.
The next question says from Jean Tischauer says, I'm a member of OMERS and receive a pension from them. Do you know if that large pension fund is heavily involved in carbon fuels investment, or are they making the transition to sustainable sources?
Yes, I can speak to that directly. And that's something we can cover in more detail next week for sure. But I'll quickly say, yes, OMERS has billions of dollars of investment in fossil fuels. And they're not particularly transparent in where all of those investments are. Pension funds have a lot of private investments, so they're not just investing in companies in the stock market. They own whole companies that don't have a lot of transparency. But I can say, yes, they do. They have a lot of fossil fuel investments, and they have been, thankfully, also making some good investments recently in clean energy. So they're starting to get their head around the transition, but it's been very slow. They're not moving quickly enough, and they need to start setting clear rules about aligning the fund with the goals of the Paris Agreement and a transition plan. So that's to say, OMERS is definitely a fund that we're working on, and we can help you to engage them constructively to do that.
The next question is one that is a real one for me too, which says, I've never allowed my guy to invest in anything that involves fossil fuels, but is it possible some of my investments have fossil fuels hidden in them, particularly in my case, mutual funds?
Yeah, that's a big issue. If you have a mutual fund or an ETF that just tracks the whole market, you might have a TSX index fund, those sorts of products. You absolutely have a lot of fossil fuels in them because the asset managers try to diversify across every sector, and they inevitably pick up large parts of that. In Canada, our public stock markets have been very overweight, heavily weighted with oil and gas in particular, because they're such a large industry. And there are a lot of big public companies that operate in that space. So you could have up to a quarter. It's gone down now because the value of those companies has plummeted since COVID started. But they used to make up a very large part of indexed portfolios. So if you ask there are fossil-free funds that specifically exclude high carbon companies like fossil fuels. And there are also funds that are what we call thematic investors. So they actually just choose only sectors that are on the helping side of the climate equation, not on the problem side. So there are lots of ways to have a low risk, high growth portfolio that doesn't include fossil fuels, but it does take a lot of work on your part to double check that your advisors or your investment manager isn't doing that on your behalf. And they sometimes are grumpy about being told to do that. So you have to sort of stand your ground.
Thank you. There's a long response from Patrick DeRochi. I'm not sure whether everyone can see these questions, but there's an answer there.
This is my colleague, Patrick, who I work with. He's on the call, and he's helping clarify. I'm just looking at the answer to the question to make sure we get a good answer there. So what's happening there, I think what Patrick's pointing to is that what Trump was trying to do is actually, a lot of investors are actually trying to exclude things like the Arctic National Wildlife Refuge or other high carbon investments. So they actually put a screen in place, which is what we call it. They say, we're not going to invest in that sector because that's just too dirty. That often happens for oil sands in Canada. They're often screened out of investment portfolios. And President Trump was trying to force the government to make it impossible to discriminate against various types of investment. So it was an effort to try to force investors to actually make those investments.
Okay,
Patrick did a better job of explaining it there in the answer, but that's my short version.
Okay, we have a question from Peter Meinke saying, please comment on investing in financial institutions.
That's a really good point, and thank you for raising it. So you may not hold directly a fossil fuel company, but if you hold investments in a Canadian bank, you also still have indirect investment into fossil fuels quite substantially. Canadian banks are amongst the largest financiers globally of fossil fuels over the last decade or so. And we saw a stat that actually showed that since the Paris Agreement was signed, which is early 2016, formally signed off on, until last year, Canadian banks financed almost $500 billion worth of fossil fuel loans and investments. So they're a very substantial part of the problem, and institutions, lots of financial institutions have those kinds of investments. So that's why it's really important to think about not just your pension fund, but also talking to your bank about it as well. And there are public campaigns in other countries that are pushing banks to get out of doing that and to set clear screens on fossil fuels. Those campaigns are coming to Canada soon, and they'll be pushing for folks to threaten their banks to take their business elsewhere if they don't make a change. So it's a very hot area of climate activism around shifting investments out of banks and other types, as well as pensions like we work on.
There are 3 more questions, and then we're going to have to wrap it up for this time and continue next week. So the first one is, where does mining fit into this? The second question is, what about the CPP?
Yep. So first and foremost, mining is a big part of this equation. There are different miners, some of whom actually participate actively in fossil fuel extraction, so particularly coal. There are lots of companies with coal portfolios. So they're sort of the worst of the worst. But a lot of mining companies are also large fossil fuel users and have large, very carbon intensive operations. So they're There are indexes you can find out there about the performance of mining companies, and it is possible to exclude or screen for certain kinds of mining. So if you don't want your, you might be okay investing in certain kinds of mining, but not those that are involved directly in fossil fuel extraction or those sorts of things. So that is a real piece of this, and there are very few sectors that aren't touched by it in some ways. So that's where you can get very simple plans like, I just want to screen out fossil fuels, and you can move up to more sophisticated levels of active investing. You're trying to actually pick investments that really meet a higher standard. I'll talk about CPP quickly as well. Canada Pension Plan, of which all Canadians outside of Quebec are a part, is actually the 8th largest managed fund in the world. It has over $400 billion in assets under management, and they own, infrastructure, real estate, every area of the economy you can think of on a global basis. They're invested all over the world. Very heavy fossil fuel investor, estimating somewhere in the $14 billion currently held range. And while they have been making some positive moves into climate solutions, they just bought North America's largest wind power developer, Pattern Energy, last year. They're still very much intransigent and not wanting to admit that this is a big problem that they need to address. So absolutely engaging with the Canada Pension Plan is critical, because they directly own a number of very large fossil fuel assets that are not only high carbon, but those companies are also involved in lobbying against aggressive climate action.
Okay. Thank you very much, Adam. It's almost 2:00. I saw one comment saying that the person could not actually see the Q&A, so I will ask Sarah to follow up afterwards with that person.
Yeah, I'm not sure. I think it at the top, but with the Q&A at all, anyway, but there should be tabs open answered for people where they can view the answered ones and the open ones. I hope that's the case.
You may need to email her later. Roy, did you want to close the seminar?
Yes, I have a quick question actually for Adam that I would like to raise. There may be parts of the financial sector that are actually more part of the solution than part of the problem. I'm thinking here of the insurance industry. You talked about in your presentation the escalation of catastrophic losses, and of course that lands squarely in the business of the insurance companies. So how can we enlist the support of insurance companies in this fight to transform the financial sector?
Yeah, it's quite interesting. I mean, insurance companies have been very the first to acknowledge, because they track this data so closely, that climate is real, the climate crisis is real, and it's impacting their bottom line now. So that's been really helpful. And they've been willing to change where they themselves cover. So they're changing their coverage, their insurance products. But they're also very large investors. Insurance companies carry large assets on their books, and they keep those invested in the real market. And on that part of it, they've been very, very unwilling to make, with some exceptions in Europe, but by and large in Canada, the major insurers are large institutional investors, just like banks or pension funds, and they hold a lot of fossil fuels, and they haven't been willing to align as well. So there's absolutely a lot of effort there needed to get them to join the same shift. So I think they should be a target as well, and having conversations with them about where they actually invest their capital when they're sitting on it is a critical piece of it. Investors have also been asked to not insure high carbon infrastructure, and that has been quite effective. So there are lots of ways of pushing that forward.
Okay, thank you, Adam. We're up. Our time is up, and there are a couple of questions that haven't been answered yet. So that means that there's more subject for discussion and debate next week. I hope you'll all tune in. And I want to thank Adam very much for the presentation, and hope you'll join us next week.
Thank you, Adam. And
Great.
thank
We'll
you.
look forward to it next week.